Hey guys, Jimmy Hobson, veteransutah.com, 801-979-6365. VA loan myth number 2, VA loans are hard to close. Okay, let's talk about that. Okay, are they really hard to close? Yeah, I don't think so, but let's see. Underwriters in the VA system are encouraged to consider every possible appropriate factor in seeking a proper basis for approving loan applications for every qualified veteran. That comes directly out of the VA pamphlet 26-7, the VA Lender Handbook, and current issues. So, crazy things can be done with a VA loan. That doesn't mean they can have 75 delinquent accounts and still get a loan. But what it does is they look at history, they look at disability rating, they look at residual value, and they use common sense. Now, sometimes common sense is that they shouldn't get a loan right now, but they do explore every avenue. Okay? All right, as long as the lenders document their reasoning, it's extremely unlikely VA staff would ever take issue with their decision. So there you go. Pretty cool. Why lenders love VA loans. So portfolio performance default rate. The VA performs and defaults under 2%. Conventional is a little over 2%, about 2.5%. FHA is actually higher than that, 6.1%. But the VA loans outperform everybody else. That's why these big lenders actually chase VA loans. Number one, because they make a ton of money on it. Because if it performs that well, obviously people are doing it, right? Simple deal. Okay. But they do perform well. They're an amazing loan. Lender's protection for default. Fannie and Freddie have 0. So they go back to the lender. Ginny, FHA is possible. They pay out a claim. With VA, it's guaranteed coverage. The VA pays out. Okay. And also, it looks good for lenders to help veterans. You know, whether that's the reason they're doing it or not. Some people actually care, but VA loans are awesome. 1 out of 7, 1 out of 8 people in a lot of the areas throughout the country are eligible for a VA loan. So they are not hard to close. Lenders, investors want those loans. Okay, a lot of myths out there. So let's talk a little more. Okay, overlays. Conventional has a ton of overlays. You know, that in theory could be with a lender. You know, even based by the guide, FHA has less, VA has even less. Now, I, as a broker, deal with a lot of lenders that have 0 overlays. They go straight by the guides. But traditionally, the VA is going to be the most flexible. They're going to have the most real-world look at a loan. Some of the things that the VA does is look at real-world things like utility costs and child care, and that's why they perform so well, right? Because very few things matter. If they've got eligibility and they can meet residual, and we can typically get them done if everything else falls in line. If they don't have eligibility or they don't meet the residual guidelines, they can have an 800 credit score and $1 million. If they don't meet residual, they don't get a loan. So the VA is very cautious about how they underwrite, but it is possible, and I can help you with that. Okay? All right. Myth number 3 is coming. Thanks, guys.